Good morning, I'm Chris Beach and welcome to Charting the Markets on IG Live. On this, the final full day of trading before Christmas for London's FTSE 100. And it is, of course, getting increasingly quiet in global markets. Not much in the way of news to drive activity so far today. But of course, yesterday we had that sudden air pocket of turbulence in US markets. Out of what you might call a clear blue sky, suddenly we had the Dow down 400 points. And everyone inevitably is scrambling for a reason to understand why the market took a sudden and such a big drop in such a short space of time. Now that comes off the back of those big gains we saw since the end of October. And you've got Christmas looming. I do think, rather than just using it as an excuse, but I do think it is just the old reason of profit taking. It's some volatility. It's very thin trading across the board for markets, not much volume, so it's slightly easier to move things around. There were no real headlines for it. I just think you have to look at the context of the past 2 months, past 8 weeks of gains, a 17% gain in the Dow we've had since the end of October, and it really shows you that markets are essentially just caught by a sudden moment of turbulence, of volatility, and so far we're expecting a more positive open for US markets this afternoon. So really, things are winding down as we head into Christmas. The Bank of Japan this week is out the way. We've had UK CPI this week. We do have, of course, initial jobless claims from the US this afternoon, and tomorrow's PCE index. That's the Personal Consumption Expenditure Index for the US, which of course is the Fed's preferred measure of inflation. That said, of course, it never gets the same kind of attention that CPI gets. The market focuses on CPI, which they know the Fed watches anyway. And so with PCE tomorrow, A, things are winding down for Christmas anyway, and B, it's never really, despite the attempt to give it more importance, it's never going to be the most important reading of the week. So just initial jobless claims this afternoon. It was a bit of a mixed session overnight for Asian markets. The Nikkei down once again, and we'll look at that in a second, really. An index that did quite well in November, but has struggled since then, really. So it's been left behind in the broader rally. Otherwise, a fairly quiet morning across the board in European indices and in FX markets as well. So starting with the indices, beginning with the Dow this time, down trading at 37,253. We're expecting that to open around 200 points higher from yesterday's close, and still very within a whisker, I think, of a Father Christmas whisker almost, of those record highs that we saw earlier in the week. This just takes the index back to one form of trendline support. Yes, it's quite a steep form of trendline support, but it's the first real knock this index has had since the beginning of the month, and really the first big down day we've had since the rally began on the 30th of October, really, when we bottomed out at the very end of excuse me, the final week of October, and then we had this huge move higher. Now, I think we're sort of conditioned to expect it maybe to pull back in the short term down towards 36,000. That might be the case, certainly over the next week or so, with more of this thin trading and little news flow. It might be conceivable that you do see the index falter from here and endure a pullback, because certainly it's come an awful long way in a short space of time. But we don't know when or why a pullback would begin. And normally January's are fairly strong months anyway for US markets, but it does look overextended in the short term. So perhaps a close back below 37,000 would again spark something more of a sell-off, because you could argue from yesterday's price action maybe there is a degree of willingness to sell the index in the short term, really. But at the moment, holding on to trendline support, the short-term view would take a bounce back towards 37,500 and put us on course for fresh record highs for the end of the year. Maybe, and we should be aware that thin trading means it can move dramatically in either direction. So just as much as it could go back down to 36,000 in a short space of time, it could even rally into year end and get us towards 38,000 and take out yet another round number before the end of the year. Tech stocks inevitably still very much in focus. This was the year that the Magnificent Seven, this new nickname they've acquired, much more exciting than FANG, it has to be said. The Magnificent Seven led the way. And there's the Nasdaq 100 for you. Yes, it managed to eke out its own record high in yesterday's trading. So it joins the club of markets that are now at or near record highs for the year. And as I said earlier in the week, it caps an astonishing 2-year period where we've seen 5,000-6,000 points wiped off the index and then promptly added right back again in such a short space of time, really. This breakout from descending channel at the end of October really delivered the bounce that people were finally looking for. And a reminder, of course, that when indices move in one direction, especially with Q4 seasonality being so strong, they tend to move very dramatically. And this is exactly what we've got now. There's trendline support, perhaps, if we do fall a bit further into the next couple of days and if the Christmas break below trendline support maybe takes us down. The first area to watch is this one around 15,900, which was an area of consolidation during the course of the second half of November. The index reaching a new multi-month high in mid-November, and then we dropped back again. So the first thing to bear in mind is that we could see perhaps some additional upside, maybe towards 17,000 as well. That's the thing to bear in mind, that the index has been very, very strong over the past few weeks. And just as we said with the Dow and the thin trading, maybe you get another move to the upside before the end of the year. And so little in the way of news flow to drive this, and so little in the way of volume. Things really could move either way. So I think it'd just be prepared for that kind of sudden burst of volatility, a repeat almost of what we saw yesterday. Moving over to the Nikkei, this is where perhaps we've seen a bit more two-way action, really. It hasn't really favoured the bulls over the past couple of days. It looked like, following on from that Bank of Japan meeting, that we'd established this higher low around 32,600 or so, because this is the key thing to bear in mind. The index hit a multi-month high towards the end of November, just below 33,800. It dropped back again, found support around the 50-day moving average. But for the time being, the sellers are holding it back around 33,500. But certainly this is a market that is still in consolidation mode rather than going back down again. And in the short term, you've got trendline support coming through from the early December lows that could continue to hold up the price and avoid any significant pullback. Certainly a close back below 32,600 might start to put more of an appreciable dent in the bullish thesis. And for the Nikkei, back to 33,900, 34,000. That's the level we've been watching all the way through since the beginning of June, really, as the barrier to further upside. And of course, from there, it's on to 38,000 and the highs from 1990. So there's still plenty of upside to go for the Nikkei before it gets to new record highs itself. FX markets quiet this morning. The theme of the past week has been a slight strengthening of the US dollar, actually, after the weakness we saw in the wake of the Fed last week. US yields did tick up overnight as well. So there's signs of some reversal in some of the trades that have been big winners over the past couple of months, namely for Eurodollar. As you can see here, that's been to buy the dip and buy that weakness in Eurodollar down at 105, which has delivered a decent 500-point bounce in the short term. Crucially, that weakness we had at the end of November, beginning of December, when the dollar was strengthening into the Fed meeting, and how, interestingly, that turned out, saw buyers emerge. So the dovish Fed really caught people by surprise. And since then, the ECB's been fairly hawkish by comparison. You've had a couple of ECB speakers over the last couple of days really saying now is not the time to think about cutting rates, which contrasts sharply with what the Fed is saying. And now, even after yesterday's CPI, what the Bank of England probably will have to do next year. So that's given fresh strength to euro dollar. We're just waiting to see whether this, certainly this volatile week we've had over the past 7 days, will resolve in a move to the upside, with a close above 110, really generating that kind of breakout to the upside that people will be undoubtedly looking for a bullish view to maintain prominence in the short term. We flick over to dollar yen, which again has been the big one this week. It looked like we could have had a bottom in play, a bounce back above the 200-day moving average, the price rallying back towards 145. And then the sellers have come back in again. Again, it's thin trading. It's easier to move this stuff around. So you just have to be prepared for some more frustrating movements, I think. But the pullback, certainly for the time being, is intact from those mid-November highs. So until that changes, until we do see, say, for example, a close, if we argue for at least trendline support, trendline resistance rather, if we get a close back above 145.50, that would break the trend line and might augur well for further move to the upside. You could sort of buy it down here with the stop below these levels. It's just a question of seeing what happens over the next few days, whether it can rally in the short term, get back to maybe 146. But it does look like, again, of course, we've had an intraday lower high on Tuesday, further selling. Maybe we get another test of the 200-day moving average just to provide some more excitement as the world begins to wind down for Christmas. And then Aussie dollar as well, FX markets sitting quite happily around recent highs and doing really well. The buyers came back in again during early December. Again, it's all about US dollar weakness really at the moment. It's regardless of perhaps the more cautious outlook for the Australian central bank as well. It's all about the US dollar and the Fed's change outlook. And that's really what's given the Aussie and the Euro and the Pound the space to rally. Well, the pound until yesterday, of course, and the CPI reading, but for the Aussie to rally against the US dollar and really start to mount a trend change here. For the view, I think really if you get a dip back towards 66, back towards the 200-day, you might still see buyers emerge. Really, you need to close back below that, back below the early to mid-December lows at 65.40 to really start to, again, put quite a bit of a dent in this bullish thesis as well. So the buyers firmly in charge. And if we see further gains in the new year, that takes us on towards 68.30 and then the highs from June and July around 6,900. Finally, commodity prices. Again, it's all about how the dollar has weakened over the past few days. We're looking at gold. We're still holding above 2,000, as you can see on the chart here. We're doing our best to try and maintain further upside. It's calmed down dramatically since that push to record highs and that equally impressive reversal back below 2,000. So again, perhaps not surprising in a sense to see this volatility around gold. A lot of people were waiting for it to go back to 2,000. Equally, a lot of people probably waiting for it to spike higher as a selling opportunity. That's exactly what we got. But we rallied off the 200-day, the 50-day moving average as well, which, don't forget, the 50 is above the 200-day now. So in a big change from the case during September, October, and November, we've now got the 50-day above the 200-day, which sort of moves you more towards buying the dips rather than selling the rallies, I think, in this case. Gains have been hard to sustain at around 2,050, but a close above that would then, I think, target further upside. Not necessarily towards that record high or as quickly as we saw the move last time, but certainly perhaps in that direction. And I think for a more bearish view, at least in the medium term, you need to see it back below 1970. And then finally, US crude. This week, of course, has seen crude prices rebound from what was an arguably overstretched move to the downside. You had the sudden news about the Red Sea and shipping companies withdrawing their shipping from that area, which meant fears of maybe a disruption to oil supplies were reignited. That's continued to drive this one higher in the short term, and it's given, I think, buyers the space they needed to rally. But again, we're rapidly moving into lower high territory here at 75. And I think if we do watch for a move back below 73, if it rolls over on the MACD as well, then you get another catalyst for a move back towards the lows of December at 68, maybe even down towards these lows from the summer and into Q1 of this year, down at 66.50, which was a really big area of support repeatedly. Even with the March volatility, we saw it dip into the 66, 67 area, and their buyers stepped in, and that's where that pullback in oil prices, that big decline in oil prices, finally stopped, and then we had the summer rally. So a big area to watch if and when we do get there. In the short term, further upside takes us on towards, again, that 200-day moving average, 77.63, and of course around $78 a barrel, which was a big area where sellers stepped in November as well. So that's the level we'll be looking for if we do get a continued move to the upside over the next few days. So it's just really US initial jobless claims this afternoon at 1:30. We do get a revision of the latest GDP data for the US as well, but not much change expected there. It's likely to be a more positive open for the Dow after yesterday's sudden drop. We're expecting it to open around about 200 points higher from yesterday's close. That's my last chart in the markets of 2023. So I wish you a very Merry Christmas and a Happy New Year, and I will see you in 2024.